You don't cover all of the names in that group, but you cover a lot of them. I wonder, is it any different covering them? Is there more responsibility? And how much is the market really relying on the fates of those four companies?
I mean, look, those are our tech leaders. And I mean, I think that's what the market is looking to. In a lot of ways, when you talk to investors, those have become market stocks. They're reflective of the direction that the market's going, and they're reflective very much of investor sentiment on where they expect the market to go.
Let's talk a little e-commerce, Heath. You guys cover Amazon, eBay, and Etsy, but not Shopify, right? Why not?
We actually do cover Shopify. It's just our software analyst that covers it, Chris Merwin, because Shopify is more of a SaaS model versus a real transactional model, the way the other companies that I personally cover are.
Well, I want to ask you then about some of the trends that are affecting Shopify, which is up considerably this morning, but also affecting the companies that you do cover, mainly giving merchants who aren't Amazon more autonomy, but also trying to give them the kind of logistics-led flexibility that Amazon offers third parties. How important is that, the autonomy plus that capability to all the players going forward who aren't Amazon?
I mean, look, we're seeing massive growth in e-commerce. You and I have talked about it before. That's being driven largely by the record number of store closures that we're seeing at traditional retail. Obviously, that puts a lot of pressure on the logistics networks. And when you look at the level of investment that the traditional logistics networks have been making in their infrastructure, it's simply not enough to be able to handle the load of 20% growth in shipment volumes from Amazon, from Etsy, from eBay, from the e-commerce divisions of Walmart, Target, all of these companies that are trying to fulfill the demand that consumers have to be able to get things faster and easier delivered directly to their home. And so it's created a void that these e-commerce companies have had to step into and fill if they're going to continue to be able to grow at the rate that they expect to, and honestly that their investors expect them to.
Yeah, when we're talking about logistics and transportation, that brings us right back into mobility. I want to get your thoughts on the Lyft numbers. The move lower today certainly seems to be directly tied to the fact that this name didn't up the profitability guidance, whereas Uber did last week. Were you surprised by that?
Not really. I mean, Uber had a lot more room to be able to take costs out of their system. I mean, when you look at the breadth of what Uber does, they're global. They've got an Eats business that had considerably more losses to be able to take out of the system when compared to the ride-hailing business. You've got all of the other efforts that Uber has that ultimately we think are going to pay off. But things like freight, autonomy, Elevate, their eVTOL business. There's just a lot more there for Uber to be able to do to get that business to rationality. And they're also operating obviously at a much higher scale, larger scale than Lyft is. And so this is going to be a business where scale matters a lot. And so for them to be able to pull forward profitability, they've got a lot more ammunition to be able to do it than Lyft, who's operating just in the U.S. ride-hailing business. Lyft is going to benefit from those same scale advantages over time as their business grows. It's just going to take a little bit longer when they're just operating in that one segment.
Yeah, Lyft is pure play rideshare, and as you mentioned in North America, Uber is much more of a conglomerate with all of these different businesses coming together. Is it safe to say the conglomerate model is potentially, at least in the nearer term, more sustainable, going to work out more positively, or is the verdict still out?
It's funny how the pendulum has completely swung on that. Back in November, Nobody wanted anything to do with the conglomerate model. The Eats business was extremely unattractive in most people's minds. Everything else was losing money. Operating outside of the U.S. just meant tons and tons of competition that investors didn't want to deal with. And now most of that's being viewed as a positive. The Eats business is getting more rational. Competition outside the U.S. is getting more rational. And that conglomerate model gives them scale to be able to operate at a level to cover a lot of the fixed costs and technology and customer acquisition that ultimately will make this, we believe, a much better model over time. We like both Lyft and Uber, but we think that given the scale that Uber's operating at, you're going to see a much bigger business coming out of Uber over the next 3 to 5 year period because they have so many different ways to win.